Group 1 Automotive, which owns and operates 206 automotive dealerships. They've got 270 franchisees and 42 collision centers in the United States and the UK, reported its results earlier today. They came in with, with earnings of $9.80 a share. That was quite a bit better than the street was expecting. $9.36 was the expectations. Revenue came in at $4.7 billion, and that was right in line with expectations. And joining us right now is the president and CEO of the company, Daryl Kenningham. Daryl, let's talk through what was a pretty difficult quarter. I hadn't really thought about it until you guys laid it all out. This was very difficult in the United States. You had, first of all, some pretty extreme weather that came through, especially in Texas and Oklahoma, and then you got hit with the CDK outage. Yet, with all of that, you guys still managed to come out with better than expected earnings. How'd that happen?
Well, good morning, Becky, and thank you. We were really pleased with the quarter. You're right. There were some definite distractions that we worked through. Our team did a fabulous job working through those. When you lose your computer systems in every one of your dealerships in the United States, that can be an impact to our teams and to our customers. But our team was able to work around those issues, and we have some technology in our back office which allowed us to close our quarter in normal timing, which we were very proud of. So really exceptional performance by the team. If you were to look at our performance through the end of May, without the effect of the CDK outage, our parts and service growth was very good. Our gross profits on our vehicles were held up well as our growth in used cars held up well, and our SG&A leverage was really good. We were really pleased with the execution of the team. And we had closed some acquisitions earlier this year that we were very pleased with, and they've been contributing very nicely since we bought those.
What would you say just in terms of the extreme weather that was taking place in Texas and Oklahoma? The second quarter is usually the toughest time if there's not a big hurricane that occurs in the third quarter. How much did that impact things? What was the cost?
We had some hail issues in Oklahoma and Kansas and Texas, and then we had some flooding in Texas, which the teams dealt with fairly well in the second quarter. And so we were able to contain those impacts. And the hurricane hit us in the third quarter in Houston, which is our largest market. We're coming out of that nicely. The power's finally back on in Houston these days. So, one of the things I think that our company does really well is we recover from events. And I think we proved that. We're the first public dealer group to announce our earnings this quarter, and one of the reasons we were able to do that is because we were able to get back in business very quickly, and I think we've proven to be very nimble as a result.
Let's talk a little bit about how the consumer is feeling. We've heard from some of the big auto companies that they are offering some more incentives than you had seen post-COVID, trying to get people back in and buying. It looks like there's a real appetite for some of the big vehicles like trucks and SUVs. What do you see overall from the consumer, how much they're willing to pay, and how much of an impact do rates have on that? If you see a rate cut, what would you anticipate?
Well, to us, it looks like the consumer's pretty healthy, and I think our OEM partners are responding well with interest rate subvention on their incentives, and we saw our gross margins on the new car side were almost flat sequentially, where they had been declining quarter over quarter, and so it held up well. And then on the used car side, we're seeing our gross margins were steady sequentially as well, and on a year-over-year basis. So I think generally we're seeing the consumer is pretty good. We still have some backlog in our order bank in the UK of around 10,000 units, which we see as a good thing. And we're still pre-selling some units in the United States, like in the Toyota brand. Almost 4,000 units are advanced orders. So, right now it looks pretty good. If there's an interest rate cut, I'm not one to predict what it would look like, but obviously, vehicles being the second biggest purchase that customers have, that should have a positive impact on our unit volumes.
Let me just ask it the opposite way. Is it a problem if they don't cut rates? Would you anticipate your customers would drop off in demand?
We don't see that. We've been living in a higher rate environment for quite a while and adjusted. And I think our OEM partners have adjusted to that, and our finance partners have adjusted to that, and our teams have. So I don't think it would impact us negatively. Yeah.